All right, in this lesson, we're going to go over preferred stock. We're going to help you understand what preferred stocks are and then the journal entry associated with the issuance of a preferred stock. So let's get started here by looking at an overview of preferred stock. So in addition to common stock, a company can issue what we call preferred stock. Now, preferred stocks may not be available for purchase by the regular public and can be restricted to a select group of individuals, including the owners or founders of the company. So preferred stock can trade on the National Stock Exchange, and there are examples of that out there that you can actually trade. In addition, preferred stock often is used when it's traded internally between the owners and founders. Another way to think about preferred stock is sometimes it's a way of getting a different class of stock to the owners that gives them preferential rights to distributions of cash later on. And so this is a great mechanism for kind of a hybrid between a stock and a loan. And that's what we're going to be looking at as we're understanding preferred stocks. Now, some differences between a preferred stock and maybe a common stock is that preferred stocks can have different voting rights, including no voting rights. So again, just like that we have the different classes of common stock, there could be no voting rights here, or there could be super majority voting rights designated to a preferred stock. Now, dividends are usually based on a fixed rate for a preferred stock rather than a common stock. So the way that common stock works is we just say we're going to declare $1 million dividend, and then we're going to calculate that based on how many shares we have outstanding, and then that's what you get. Preferred stock, on the other hand, usually has a percentage that is associated with the preferred stock. So an example, it might be a 5% company A preferred stock. And in that case, what that means is that this preferred stock is going to pay 5% dividend to the preferred shareholders based on the par value of that preferred stock. Now, we'll talk about, when is this optimal later on, but basically it acts like a debt. Right? So you issue preferred stock, 5% preferred stock. It basically is like a debt. Now, there are some different flavors of preferred stock. So it doesn't mean that every year this preferred stock is going to get 5% based on the flavor that we're going to give to it, which we'll talk about in a minute here. But this pays a fixed amount of 5%. Okay, so that's kind of how these work. They more look like a loan than they do actual stock. Now, one other difference is that preferred stock receives first preference on dividends, hence the name preferred stock. So when it comes to dividends, dividends must be paid to the preferred shareholders first, and then whatever left goes to common shareholders. So when we issue a stock, the issuance of stock is very similar to the issuance of common stock. The only difference is we're going to change the name of the credits here. So debit cash for X amount of dollars, and then credit preferred stock. Par value would go here if we have a par value, and then the rest would go in additional paid in capital. Now, if you don't have a par value, which you wouldn't have a par value, usually you would have a par value, you can just use preferred stock as your credit and then no additional paid in capital. But because of the percentage that goes along with the preferred stock, usually there is a par value, and that par value is what we use to calculate the dividend that is required to be paid to those preferred shareholders. So let's look at an example here just to help us kind of understand that journal entry. Assume company A issues 5% preferred shares at a total price of $15 per share with a par value of $1.50. Prepare the journal entry for the issuance of the shares. So the first thing that we need to do is figure out how much cash we're going to receive. So in this case, we've got 5,000 shares, and we're going to sell them at $15 a share, which would give us $75,000. So by issuing 5,000 shares at $15, the company's going to get $75,000. Then from there, we can do another intermediate calculation to figure out how much is going to go into preferred stock based on par value. So in this case, it's going to be 5,000 shares times 1.5 because that's what the par value is. And in this case, you're going to get $7,500. So once we have that, we can do the journal entry. The first thing that we know that we're going to get is we're going to get cash. So we're going to debit cash. So we'll debit cash here in the amount of $75,000. And then we're going to credit, instead of common stock, we're going to credit preferred stock in the amount of $7,500. And then we're going to credit additional paid in capital. But again, this is for preferred stock. So we'll put preferred stock or PS, and that's going to be for the balance of $67,500. So that's what our journal entry would be for a preferred stock issuance. We're going to separate our par from our non-par amount, and then we're going to book those into credits, and we're going to debit the actual cash. Now, one note about repurchasing a preferred stock. So when a company decides that they maybe want to repurchase it, oftentimes when they're repurchasing it, they're not purchasing it to hold it off the side, but they're actually repurchasing it for the purpose. They are typically not repurchasing preferred stock to reissue. They're pretty much purchasing that preferred stock to retire them. So as such, we don't really repurchase preferred shares. We instead retire preferred stock. So AKA, we call this a preferred stock redemption. So when a company goes out and buys back their preferred shares, that's called a preferred stock redemption, because the company's going to retire it once they get possession of it. Why are they going to retire it? Well, because it comes with that 5%, that 10%, that whatever percent dividend that is required to be paid to those preferred shareholders first, rather than common shares holders. So instead of having to do that, they take the preferred shares away, and then they can take all of the income and be able to pay common shareholders. So that is a key aspect here of preferred stock repurchases, is that we're going to retire them. We're not necessarily going to reissue them. So that is a look at preferred stock. In the next lesson, we're actually going to go through a preferred stock dividend. We'll show you how we calculate it, and then we'll show you what that journal entry looks like on that end. So until then, we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.